Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. Yesterday saw one of the most anticipated Reserve Bank board meetings in years. Following the US Fed's declaration that rates would start rising soon in the world's biggest economy, there was a lot of anticipation and perhaps pressure on the Reserve Bank to bring forward its own interest rate guidance. But the central bank made it pretty clear it would remain patient before doing anything about the official cash rate. In fact, there was little suggestion that the bank will do anything this year. It did end its $350 billion bond buying program, which will free up long-term rates, at least let them rise anyway. To help us make sense of it all, we're joined today by Oster, Chief Economist at National Australia Bank. Alan, welcome back to Fear and Greed.
Thank you very much. Always pleasure to come back.
Thank you. So what do you make of the meeting yesterday? Were you surprised at what the bank said?
Short answer is no. What they've essentially done is they've said, look, inflation's a bit higher than where we expected to be, but it's nowhere near where you would need to be to start us changing rates. They said wages are also quite moderate and it'll take a while. They've reduced their GDP numbers, but they have given themselves some room, I suppose, in case things get better or worse than expected, that they might start doing something. We have the first rate rises in November and December, and having looked at that statement, nothing's changed.
The bank does talk about inflation being higher for quarters, plural. I mean, underlying inflation last quarter was 2.6. You get another sort of 6 months down the track, you get higher levels of inflation. Is that what we need? And when I read that yesterday, I thought, I'm not so sure actually that they're even saying this year. I suppose that's my point.
Well, yeah, I think the risks are November or maybe February. What they're basically saying is if you assume that you're going to still have reasonably high core inflation, and there's reasons to expect that given the technical nature of what they do, in large senses, a large bit of the trim mean is actually occupied by the increase in owner-occupier costs of housing.
Right.
So, a lot of the trim gets taken out by one item. So our forecast would have core inflation at 3.2 by September. But like the RBA, once you get the other side of the economy operating more normally, in other words, living with the virus, you have more people coming in and some of those tensions might erode away a bit. So, I think this was, and we'll hear more from Phil Lowe today in relation to his speech. And then on Friday, they put out their forecast. But I think the idea is, well, it could be late 22, maybe 23, but we're going to sit around and wait for a while, guys.
Certainly they've dropped their 2024 commentary. Yeah. So they're thinking about it. What about the wages story? Because they do seem reasonably sanguine about wages, notwithstanding the anecdotal evidence.
Well, they're laser focused on wages. What's happening in a fundamental sense is that because you don't have as many people actually in the country, there's shortages, and we're going to put out something on Thursday on a quarterly business survey where we're the highest of all time. Employees saying they're finding it difficult to get suitable labour. So they're saying it's almost impossible to get people. And so there is elements in some sectors where you're seeing essentially employers increasing wages to try and get them, but it's not everywhere. We do expect to see essentially wages growth in the next couple of quarters up around 2.75%. Maybe 3%, which is where the Reserve Bank is sort of expecting as well.
Yep.
But what they're saying is once you get the other side of the normalisation of the economy, then things might ease back a bit. So wages is, if you like, the one thing you need to get growth up around 3 or thereabouts. Once you get rid of the idea that you have temporary short-term increases in inflation because of things like petrol prices and owner-occupied costs, etc.
Hence the focus on wages every time the Reserve Bank speaks.
Yep.
What about the bond buying program? Ending that, what does it actually mean in real terms for most of us who take out loans? Does it mean that much?
Short answer is not a lot. It means that they're looking at what other economies around the world or central banks around the world are doing. Most of them are finishing. And so therefore they don't need to keep buying the bonds. It's a sort of another way to keep the currency low. But if they're not buying the bonds, there's less support for the bonds, and therefore the costs of 2 to 3 year loans for banks, if you like, goes up because the market all around the globe is pricing in increases in rates, and they've been artificially keeping the long bond lower by buying it, and they've stopped doing that.
So what do they do with the bonds they've now got in their portfolio? Presumably a central bank doesn't want to hold on to them forever.
Well, they are buying, or they have been buying, basically bonds that go out 2 to 4 years.
Yep.
And so in some ways, if they don't do anything, those bonds just mature and they disappear.
Yep.
But they're muttering about whether they might play around with the portfolio in terms of it's not too lumpy, et cetera, et cetera. But I think in the big picture, it's not really a lot of policy other than to the extent that there's less support for the fixed cost of borrowing money. It is a slight tightening, but it's not anything like interest rates.
Stay with me, Alan. We'll be back in a minute. My guest this morning is National Australia Bank Chief Economist, Alan Oster. Now, you mentioned the economic forecast and they downgraded growth slightly. We'll hear, as you mentioned, more from Phil Lowe today, and then on Friday, the semi-annual statement on monetary policy, I think that's called, which will give us the forecasts. Why do you think they've downgraded growth forecasts?
What they've done is they've done December on December. And what you know is last year, December was really strong. But we also know that we had Omicron in January. So the first quarter is going to be quite weak. On our numbers, we were expecting growth through the year of around 4, and then we've taken it back to 3.5. They've taken it from 5.5 back to 4.5. And I think basically a little bit of reality is coming in, but also, you've had a soft start to the year. But because December was so strong, it probably means in year average terms, which they're not talking about, the numbers would probably go up. So it's sort of, data moving in and around according to the virus. It's not really a fundamental change, although they did lower their growth rates for the out years 23 a lot. So they're down to about 2.5% now.
Okay, and the bank thinks that unemployment will fall below 4% this year, which probably isn't a huge guess given that it's at 4.2% already.
Yeah.
But again, that's an upgrade.
It's an upgrade. So the labour market's stronger. So temporarily you'll see unemployment go up a bit, but then goes down a bit. So I think we're at 3.8, 3.9 by the end of the year. And then you basically stay at around 3.8 or a bit lower for the rest of the forecast period. So, they're basically saying that the labour market has done better than we thought. It won't forever continue to keep going down in terms of unemployment, but it's, you do need to have unemployment below 4 to get wage pressure going in a fundamental sustained sense. So that's also important. So they're again saying that sometime this year, which probably means late this year, which sort of fits into our view that rate rises November, December, probably likely.
And the big risk to these forecasts, still the coronavirus?
It's always the coronavirus. There's also a risk called, do you get wars in Russia or Ukraine or Taiwan? That would sort of put the cat among the pigeons. But I think the big risk is essentially the virus, if you get mutations, and also essentially how the economy deals with it. So far it's been sort of dying when they put the lockdowns on, but then sort of comes back really quickly. And everything we see suggests that Omicron's a temporary thing rather than a permanent thing, and we're not having lockdowns anymore. So therefore, once you get past the first quarter of this year, I think growth will come back pretty strongly.
Just one final thing, Alan. When other central banks, the US being the obvious example, but if Bank of England's already started, if the ECB starts to lift rates at some point, does that put pressure on the Reserve Bank of Australia to lift interest rates?
Short answer is no. It probably means the currency goes down a little bit relative to everything else. But you've got to remember these central banks are looking at inflation rates that are very different. So, for example, in the US, they're trying to hit a 2% inflation target and they're currently 4.9. In New Zealand, for example, that everyone hears about the rate rises there, they're basically trying to hit an inflation target of 2 and they're 5.9, which is the highest inflation rate for 31 years. So we're currently 2.5 and probably on the way to maybe 3, and they're targeting 2 to 3. So very different outlook in terms of where these countries are starting.
Did we get lucky, or have just been really, really well managed the last 3 or 4 years?
I think basically most people think that we were not so well managed because wages went significantly down, and the RBA hasn't hit their 2 to 3% target for 5 years. They've missed it for 5 years on the downside. And so they might let it go a little bit higher than 3 for a while before they actually react.
Alan, thank you for talking to Fear and Greed.
Thank you, Sean.
That was National Australia Bank Chief Economist Alan Oster. This is the Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.